Pause whatever you're doing right now, because if you glanced away from the markets yesterday, even briefly, you missed one of those rare moments that doesn't just move prices, it shifts confidence, reshapes portfolios, and changes how people feel about risk in a single afternoon. And no, that's not hype. This wasn't an ordinary dip. This was a floor giving way beneath everyone at the same time. I'm recording this. The New York Times timestamp reads Saturday, January 31st, 11:58 p.m. Drop a comment telling me what time it is where you're watching from, because I want to see how fast this story is spreading globally. A quick note before we dive in, we've officially launched our channel membership. If you want shorter, sharper analysis without the filler, check the join link in the description. Now listen carefully. For months, people were acting like the metals market was an escalator that only went up. Gold rising, silver surging, everything metallic and shiny moving higher. And anyone who dared to say, maybe manage your risk, was brushed off like they didn't get it. Then Friday arrived, and it didn't just humble the market, it embarrassed it. In a single session, the mood flipped from unstoppable optimism to stunned disbelief. Gold took a hard hit. Silver didn't just fall, it looked like it was shoved off a ledge. Platinum and palladium were dragged down right along with it. And if you were holding anything leveraged, you felt the kind of pain that makes people swear they're done trading forever. But here's what most people still don't fully grasp. The crash itself isn't the most frightening part. What's far more unsettling is what that crash exposed. How fragile this entire trade had become, and what that fragility suggests about what could happen next. Because the real question isn't just why prices dropped. The real question is whether this was the end of the move, or a deliberate shakeout designed to clear the field before another leg higher. And that distinction matters far more than whatever number flashed on your screen. Before we go deeper, check the description. I've placed bonus links there, including access to a premium WhatsApp channel and our channel membership. If you want updates the moment I see conditions shifting, that's where you'll find them. No noise, just signal. All right, let's rewind. For nearly a year, metals moved like they were racing a departure gate. Gold didn't just rise, it charged. Silver didn't just climb, it went almost vertical. And whenever markets go vertical, two things inevitably appear. New buyers who assume it's safe, and experienced players who quietly begin mapping exits. Then came Friday, a day that landed like a heavyweight punch you never saw coming. Gold fell close to 10% in a single day across many markets, and on paper exchanges, the moves looked even worse. Silver's drop was the kind of number you read twice because your brain refuses to accept it. Platinum and palladium followed suit, sinking as if they were tied together. Let me add texture here because numbers alone don't capture how this felt. Going into the close, gold was trading back under 5,000 in many quotes, after flirting with the mid-5,000s just days earlier. Silver had been behaving like it wanted to live above 100, and then, in one violent move, it was suddenly nowhere near that line in the sand. The so-called forgotten metals, platinum and palladium, were dragged down too. That's why this wasn't just a metal story, it was a broader risk event. And here's where things got strange. The paper market didn't simply fall, it warped. On certain screens, near-month contracts behave differently than spot prices. That spread is a tell. When front-end pricing disconnects, it's a sign that traders aren't calmly negotiating value. They're scrambling for liquidity and collateral. That's what forced liquidation looks like when you zoom in. Now I'm about to say something that will light up the comments. If you think this move was driven purely by fundamentals, you're probably mistaken. Fundamentals don't shift in a single afternoon. Positioning does, liquidity does, and reflexive selling can turn a push into a free fall. So what was hiding beneath the surface like a tripwire? First, the gains themselves. When an asset runs that hard, a massive amount of profit ends up in the hands of people who aren't loyal. They don't believe, they rent exposure. And rented exposure vanishes the moment the chart turns ugly. Second, options gravity. Every large market develops magnetic price levels, areas where dealer hedging flips, where gamma changes sign, where flows reverse direction. You can't always see it, but you feel it when price slices through levels like they're not even there. Third, collateral pressure. Around major volatility events, clearing venues often tighten requirements. They're not doing it to punish traders. They do it because volatility increases default risk. But from a trader's perspective, it's brutal because it forces selling at the worst possible time. And when metals are the thing moving, metals are what gets sold. Fourth, the dollar response. The dollar index jumped and hovered around 97. That sounds dull until you realize how many automated strategies immediately reduce commodity exposure when the dollar strengthens. Even a modest move can trigger massive flows. Fifth, the narrative snap. Investors went from rates are coming down soon to maybe not in the time it takes to heat popcorn. That belief doesn't have to be correct. It only has to stick long enough for weak hands to exit. Now here's the cliffhanger. The biggest clue about what comes next isn't in the price. It's in how quickly the market heals after forced selling ends. Because if the underlying demand is real, it will show up where panic sellers can't hide. We've seen this pattern before. In 2008, gold sold off with everything else, not because the thesis failed, but because people needed cash. Once the liquidity shock passed, gold entered a multi-year rally. In early 2020, the same thing happened. A sharp hit during the scramble, followed by a powerful rebound as policy responded. Silver's history is even more dramatic. It doesn't glide. It explodes, then collapses. Then rebounds so violently people call manipulation when it's really just a thin market fueled by emotion. Recently, silver printed levels around $121 in January on some benchmarks. That matters because it tells you how stretched the rubber band had become. The more stretched it is, the more violent the snap, in either direction. So no, you don't get to assume it's over. And you also don't get to assume it's instantly going higher. The market is going to make you earn the answer. One more thing. After crashes, spreads widen, liquidity dries up, and price action becomes erratic. The following week is often full of fake moves. Trade smaller. Breathe. Wait for confirmation. Now let's step back to the bigger question. What does history do after days like this? When chaos erupts, the price you're seeing is not calm discovery. It's a snapshot taken in the middle of a stampede. And stampede prices are deceptive. The real battle happens after the first wave of forced selling is finished. Yes, we'll talk about what happened. But more importantly, we need to understand the mechanics that turned a bad day into a meltdown. Then we zoom out and ask, historically, what tends to follow? The initial catalyst everyone latched onto was the announcement of a new pick for the top central bank job. The market heard sound money and did what markets always do. Repriced expectations, stronger dollar, shifted rate paths, tightening assumptions. In an overcrowded trade, that was enough to pull the first brick from the wall, but that explanation is too neat. If you're telling me a single personnel headline explains silver getting body slammed in one day, I'm pushing back. Markets are rarely that clean. More likely, the headline was the match, but the room was already soaked in gasoline. Extreme positioning, overheated sentiment, massive options levels, margin dynamics that can change mid-game. And when all of that aligns, you don't need a big spark. You just need a spark. Here's how the cascade works. And it's the same movie every time. Step 1, price slips. Not a crash, just a slip. Step 2, that slip hits a zone packed with stop losses, liquidation triggers, and automated exits. Step 3, those orders fire without emotion. They don't care about value. Their only job is to exit. Step 4, that selling pushes price lower, triggering the next cluster of exits. Dominoes fall. It doesn't stop because people calm down. It stops when forced sellers are exhausted, or a deep-pocketed buyer decides price is absurd. That's when the sharks arrive. They understand structure. They sense where weak hands sit. They know where exits are clustered. When the cascade begins, they press. Not because they think the metal is worthless, but because they understand the plumbing is about to clog with panic. And when the panic is done, they cover, quietly, aggressively, sometimes ruthlessly. Add leverage, and it gets ugly fast. Futures traders post only a fraction of the position's value. When price moves against them, margin calls arrive instantly. No negotiation. Pay or you're out. Leveraged products can force exits even earlier to protect the platform. That means positions are closed at the worst possible moment, right in the middle of freefall. Leverage is a chainsaw, powerful when handled carefully, life-changing when it slips. Yes, the dollar matters. Yes, rate expectations matter. But the true engine of days like Friday is mechanical selling amplified by leverage. Now look beyond metals. Stocks wobbled. Not a collapse, but the mood shifted. Indexes slid. Tech felt heavy. Crypto didn't save anyone either, behaving like a high beta risk asset instead of digital gold. And miners? If you hold them, you felt it. They often fall harder because costs don't drop, just because price does. But miners also tend to rebound harder once metals stabilize. That's why the next few sessions matter. Zooming out, truly massive single-day drops are rare. When they occur, they usually sit inside bigger narratives. Credit stress, policy shocks, systemic leverage. Big drops are about systems, not stories. Often, the first move after chaos is a violent snapback. Not because everything is fixed, but because imbalance was extreme. Too many sellers, too little liquidity. Then someone with cash steps in. But not every crash is a gift. Some are cracks in a longer break. The challenge is telling which one you're in. Gold and silver aren't twins. Gold is deep, institutional, restrained. Silver is smaller, thinner, and emotionally charged. It rips higher and collapses faster. That's why silver days feel impossible while gold days feel shocking. So here's the key question for the week ahead. Do we see follow-through selling or stabilization? Early strength suggests forced sellers are done. Weak bounces that fail suggest distribution continues. Sideways chop suggests a new equilibrium forming. Remember, paper prices after crashes don't always reflect reality. Spreads widen, physical markets behave differently, patience becomes a weapon. A one-day dollar jump doesn't erase debt, deficits, or policy incentives. And extremes on both sides need humility. Bulls must accept corrections. Bears must accept rebounds. History leans bullish after extreme down days over time, but timing is the trap. Margin rules matter. Liquidity rules matter. This wasn't just opinion, it was structure. So don't let one day hypnotize you. If you managed risk, Friday hurt, but you survived. If you didn't, it was a wake-up call. Not because metals are evil, but because volatility doesn't care about conviction. Longer-term forces didn't vanish overnight. Governments still favor growth. Geopolitics still simmer. Monetary credibility is still tested. Institutions don't abandon gold because of one red candle. Silver's industrial backbone remains real. And here's the subtle takeaway most people will miss. A bubble popping and froth being cleared are not the same thing. True tops are processes. Single-day crashes are often purges. So we watch behavior, not headlines. If this helped you think clearly, subscribe so you don't miss the follow-up. Check the description for bonus links and deeper research. And remember, one red day doesn't invalidate a plan. Take care of yourselves. I'll see you next time.